Good afternoon, everybody, and welcome to this final session of day 2. How is technology changing trade? So this was actually the theme of the day, and we've had a lot of discussion around the role of technology, digitization in trade finance, how legal reform can enable digitization in trade finance. We've also had an exciting session this morning on space tech, looking at how space tech and ESG are working together. And we've also had a really stimulating conversation around digital and the digital agendas and ESG targets as well. What's very clear from what we've heard today in terms of different technology solutions is that technology has a huge potential to change trade and the way we finance trade, but it's more than digital trade finance. So we need to think about what it is that we're trying to achieve with new technologies and why we're using so much technology now. Technology has to be an enabler. That's something that came out very clearly from the sessions, but there's also a very clear role in trade facilitation and managing trade so that it's done in a more sustainable way. In other words, we know that technology is changing trade, but what do we need to do to encourage take-up, manage security risks, and make it sustainable? And actually, Andre, something very close to your heart as well, make it investable as an asset class. So with me to discuss these really exciting themes and to summarize the day and look at the future as well, a little bit of crystal ball gazing, are Andre Casterman, who's on the Fintech committee and the committee of ITFA and the board of ITFA. He's independent, obviously works for Casterman Advisory, his consultancy firm, but he's also on the board of Trade Tech, Intix, and so much more, so much experience in this whole space. And then I'm also delighted to welcome Michel Kilzi, who is the founder and chair of Fineon, as well as a serial technology entrepreneur. So talking about how technology can change trade and how it is changing trade is pretty much, as a serial technology entrepreneur, Michel, your bag. How is technology changing trade?
Thank you, Rebecca. Definitely technology has a huge impact on trade and trade finance. And as you know, prior to the pandemic, the trade finance gap was on a decreased slope. But unfortunately, through the pandemic, there's some of the incumbent banks that are de-risking on trade finance, and therefore the trade finance gap is growing again. And today we are around at $1.7 trillion of trade finance gap. If we deep dive into this, we realize that around 40% of those transactions that are not funded, that are not financed by the mainstream financial institutions, being banks or non-banks financial institution, the 40% is behind it is lack of transparency into the underlying risk. So it's all about data enrichment. It's all about to unlock a granular visibility into the underlying risk. And when we tackle the export trade, it's all about the overseas buyer, the overseas obligor. So at Fineon Exchange, for example, the value proposition behind the platform is to turn those transactions into more investable transactions. So the first aim of the platform is to start gathering different data touch points around a specific transaction to data enrich certain data sets that will enable any credit officer to look into the transactions. Simply because today there's lots of those transactions that are not being assessed by the credit officers or credit committee, simply because it lacks data and information around it. In a second instance, today with the advancement of technology and specifically artificial intelligence, through the AI, we are able to look into the pain points and the weaknesses of a specific transaction and to try to come up with certain recommendations around credit enhancement. So at Fineon Exchange, we have built a robot advisor that acts as the AI behind the platform to seek different data touch points and find out what kind of credit enhancement can be brought to the transaction. And the AI as well is going to matchmake this specific transaction with alternative funding sources through the matchmaking process. So today we know that all of those exporters, they obviously have their house banks with long-term relationship, but sometimes they are seeking alternative financing ways. And through the technology and the power of AI, this is becoming possible by matching a specific transaction with the credit lending criteria or strategy of some, let's say, alternative funders, being NBFIs, non-bank financial institutions, or even banks that are not within the spectrum or the accessibility of those exporters.
Absolutely brilliant introduction. And I guess if I had to summarize that and then turn it into a question for you, Andrea, I'd say what we're seeing is a trade finance gap that isn't going away and that's actually become worse. And this trade finance gap isn't for the largest organizations, the ones that are most investable and get trade finance anyway. It's for smaller organizations, so and particularly in emerging markets, actually. And I mean, you say that the trade finance gap has increased to $1.7 trillion. That's the ICC figure. The Standard Chartered actually came out with a figure last year of $3.4 trillion. So we know that this is a massive problem. And the World Economic Forum, that's never knowingly to be undersold, also came out with a figure which was around 2.8 trillion. So I mean, actually the ICC is quite modest on the size of the trade finance gap at the moment. So what you're pointing to is a problem, which is there's a lot of technology out there. What we need to do is get that to the SMEs, get some kind of acceptance, because the businesses themselves are investable, but also the sector as an asset class is investable as well, isn't it? So Andrea, I don't know whether you want to pick up on that. I mean, things aren't being picked up. Electronic documents aren't being used to the extent that they should be. Trade is still largely manual. We've had that over the last couple of days. We've heard that many, many times. What is the problem that we're trying to solve here?
Yes, indeed. How is technology changing trade? Basically, technology is changing trade step by step in a way, and we'll discuss the obstacles, but technology can help actually increase economic activity, because whether we're talking about the one or the other technology solutions, and I definitely want to expand on this during this session, the goal is to increase connectivity, business connectivity between corporates seeking funding and funders seeking transactions to fund. Whether we talk about risk cover or liquidity provision, it's all about getting the demand and the offer to meet. And technology through platforms, and Michel represents one, is there to offer those marketplaces, platforms, ecosystems, whether we call it one way or another, to facilitate this connectivity between players that didn't know each other outside of particular transactions they're going to engage on. So basically being able to discover one another, to negotiate and to transact is the goal of technology. And the way to achieve it, I think the industry has done great work and continues to do great work on the SME side with supply chain finance platforms. There are dozens of supply chain finance platforms these days, and it seems that those new platforms that have emerged over the last few years have basically extended the offering that large banks started with 20 years ago. The Citibank, the JP Morgan, the BNPs, the Santander, of course, had launched, approved payables financing or reverse factoring, where a large buyer approve invoices for an SME supplier or a mid-cap supplier, and the funder could be a bank or a non-bank funder through a platform can extend liquidity to the SME on the back of a risk backed by the large buyer. And I see these days a lot of new platforms popping up. I'm discovering them not every month, but quite regularly. And they act at local level, at regional level. They are backed by purely technology firms, and the funding can come from banks. But I think those have demonstrated that technology through automated workflows can extend funding to the ones who need it, the SMEs, by collaborating with the large buyers. And that's supply chain finance, basically.
Sure. I have to ask this question because we've skirted around it a little bit, and as an independent, you can probably say something on this. Supply chain finance has been a bit of an issue, hasn't it, over the last 18 months, not least because of the green seal phenomenon. We have to talk about that because I think it's disingenuous not to, because a lot of these technology platforms, as you say, have been tarred with the same brush that because of green seal. They've got it's kind of, it must have affected the usage and the uptake of those types of platform, and yet the systems, the technologies on those platforms should prevent those sorts of things happening. And I think we need to distinguish, don't we, between what's proper supply chain finance and the proper use of technology, and what actually wasn't technology driven supply chain finance in the first place. I don't know whether you want to say something on that.
Yeah, I mean, technology is also a great tool for increasing transparency and combating fraud. Fraud can happen at any point in time. And indeed, transparency of the trade asset, of the trade transaction, following the issues you've just mentioned now, and others we have seen on commodities in Singapore in 2020. It's all a matter of lacking transparency and funding on the back of a trusted relationship. But things can go wrong. But technology actually, and in particular, DLT technology, although I don't want to be too specific because I want to talk about the goal, not the means to the goal, but the goal is to be able through technology to offer end-to-end transparency on the assets, the transactions that the funders or the credit insurers are basically engaging on. And that is basically what public DLT offers. If you track a bill of exchange, an electronic bill of exchange, or an electronic bill of lading on a public DLT, you can actually, as a credit insurer, as a funder in the secondary space, have visibility on the life cycle of that asset through the public DLT. And you could every hour or every 10 minutes or every day have an API call to the DLT to check that the asset is still the one you started funding. If the asset attributes change, then the public DLT will be changed and you will know something happened. So technology is now enabling this transparency. And I see through my activities in the payment space the same desire for increased transparency in the cross-border payment space, because lacking transparency becomes kind of unacceptable these days in transaction banking.
I think that's a really important point. So DLT, or blockchain technology, distributed ledger technology, is one of the solutions that we have out there. And Michel, maybe this is something you'd like to come in on, because there are so many different technologies out there, aren't there? So that can alter the way in which we finance trade and the way in which we can therefore do trade in the future. And Coriolis actually did some discourse analysis recently. So we ran some natural language processing through a whole load of articles all the way around the world to see where the big themes were. One of the things that I found particularly interesting was that we were talking this year less proportionately about blockchains and more about cloud-based solutions, automated solutions. So Michel, particularly the types of things you're talking about, which is the role of machine learning, artificial intelligence, and those types of things. Do you think that's because it's actually more user-friendly? It sounds like machine learning and robots and robotics and everything, it sounds a little bit more user-friendly than blockchain and immutability. It's just a bit easier to understand.
Yeah, obviously, when it comes to fraud, before tackling the platform as a service, those guys are extremely creative and innovative in the way they fraud. So it's not quite easy combating or trying to reduce the fraud element. But when it comes to a platform and creating this super conduit, or as Andre was saying, the business connectivity, it's all about getting those stakeholders into one place, into sharing data. And once this data is streamlined in the right process, you start unlocking transparency that is really essential to have a better view, a granular view on the risk. And creating this kind of a collaborative platform, what we call at Fineon a relationship management tool, where you're getting eventually the exporter and his buyer, the underwriting market, the credit insurance market, eventually the credit bureaus and the credit information providers. This is when everything becomes transparent, and you start detecting potential suspicious transactions or anything that is doubtful. And this is a way to unlock or reveal those kinds of fraudulent applications. So we're trying as a platform as a service, to create, if you want, the Amazon of trade finance, where everybody is here dictating their own rules. And at the end of the day, we shouldn't forget that it's all about trust, and trust comes from value. So it's all about putting really the corporate, the exporter, in the driving seat. In the old days, it was the banks who were dictating the rules. Today, into this new economy and shared economy that is all data-driven at the end of the day, it's really to unlock the real value to the exporter, represented by working capital support, trying to mitigate risks, to give them access to financing, which along the way of the chain is unlocking new sales, is providing them with tools so they can export more into what we call the exotic markets, or the emerging markets, where there's less, let's say, access to governance, to financial statements, to relevant data that are essential to unlock of a funding transaction.
I think there's just so much there, but what's really intriguing about this approach that you're taking, which is very different and very innovative, it has to be said, and we know that Coriolis is trying to do similar things. It's actually to take into account the demand side. So this is all about market creation. And Andrea, I think what COVID has done over the past 20 months or so, and the problem, which is this huge trade finance gap, which we see for small and medium-sized companies, the problem's become very clear that banks don't speak SME and SMEs don't speak bank very well. And so if you can actually get those two on a marketplace where they're talking the same language and put in place the relevant sort of fraud detection systems, then actually you've got something that's like a dreamland, haven't you? But how do you drive traffic to that? How are the solutions actually driving traffic to this side of things? Because I can see the attraction from the bank side, but maybe from the SME side, it's still too difficult.
Yeah, that's, traffic has been materialized indeed on supply chain finance platforms, again, because for the funder, the risk is on the large buyer and not on the SME. Once you move up in the value chain and you do post-shipment finance pre-approval of the invoice, so you have a receivable to be financed from an SME, then it becomes much more riskier for the funder. However, then maybe the funder might not be a global bank that is focusing on the top-end corporates, the blue-chip corporates, but the funder might be a non-bank financial institutions interested in higher risk transactions, working on portfolio basis, possibly working with a credit insurer. And we're getting outside of the traditional banking space, more into indeed the non-bank FIs, those trade finance funds that are funders in the primary space, sometimes also funders in the secondary space, but definitely the margins for them are much higher in the primary space. But the risks, of course, are higher as well. So we see indeed getting closer, to the factoring space, where the partnership with credit insurers is crucial, because some funders will want to take the liquidity premium, but not the risk premium. And we see indeed some moves into single invoice financing. The margins can be huge for funders, but the risks as well. And this is where the more transparency funders get from those SMEs, the more historic data the SMEs can offer, not only on themselves from a balance sheet point of view, but also on their relationship with their buyers. If the buyers has always been paying on time since a couple of months or years, that will enrich the AI algorithms that will determine the risk of this particular receivable. I think the challenge for the market is moving indeed from approved payables financing, which, as I said, has been a great development over the last 20 years, first by the top banks, then regional banks, then those new platforms. But we need to move beyond this, because not all receivables can be approved by a large buyer. The bulk of the market are unconfirmed receivables. And this is where also on the ITFA side, what we're trying to achieve, also with yourself, Rebecca, is digitizing those bills of exchange, those bills of lading, because often they can be used as a collateral for financing. So if you have an electronic bill of exchange that can be indeed handled on a platform in a few minutes, that's a great collateral for the funder to finance a trade loan or trade receivables. And this collateral should not be underestimated. Yeah. From a risk point of view.
It's really interesting, because this whole element of risk, and I think the documentation and the electronic documentation, it's not just a financial document, is it? Because there is so much contained within that bill of lading information or bill of exchange or even a promissory note, but particularly the bill of lading documentation. There's so much information in there that it actually helps with fraud detection. So, I mean, you can actually verify an electronic bill of lading. You can actually verify whether or not a ship has gone from A to B. The technology is out there. So surely over time, this actually reduces the amount of risk that's seen on these platforms. And enables more organisations and counterparties to get involved. So I mean, just coming in as a comment, really, there is an element of using that technology to manage that risk across the spectrum.
Yeah, because you can always find funders, but the funders will. I mean, the key is the risk assessment, not just the credit risk, but the fraud risk as well, and whether you keep that as a funder on your own balance sheet or whether you shift that role to the credit insurer, the need for data on the particular transactions to be funded, to be covered from a risk perspective, is key. So indeed, feeding the risk engines with the new electronic transaction data sets that are available in some systems is critical, because those receivables will not be funded on the back of the buyer approval of the invoice.
Exactly, and I guess I go on to say that ultimately technology is a tool rather than an end in itself, isn't it? And we have to, you know, a hammer's absolutely useless unless you've got someone to wave a hammer around and an object to hit. So, you know, you have to have goals that you're trying to achieve with technology. And so, I mean, if we identify one is creating the market, which is what Fineon is trying to do. Another is trying to get the data and analytics to work with those platforms as a service. Then actually, does that help us explain why we need more technology in trade, Michel? Or is that something that you think, well, you know, we can do with what we've got? Can we use the technology that we have for more purposes still?
Sure. At the end, as we were saying, it's all about creating value and putting the exporter in a place where they can optimize on their working capital, on their funding and risk mitigation. And it's all about getting transactions more investable. So by putting the transaction at the forefront of the equation, by collecting relevant and sufficient data, by offering advice on transaction structuring, you have lots of treasurers, CFOs. They don't have this knowledge on how best to structure a transaction that will be presented to a funder through credit enhancement and risk mitigation, and definitely through credit insurance. Okay, this is how you end up creating an asset class that becomes attractive to the buy side being the FIs and the non-bank financial institutions. Then from the other side of the equation, those FIs, instead of searching for a needle in a haystack, the funders can simply input their credit lending criteria, their credit lending strategy, what type of assets they're looking to acquire. Is it ESG compliant, market risks, ticket size? And then, for example, through Fineon, they get matched with the transaction that fits their appetite. So they can really optimize on the origination side. And at the end, this is all about added value to enable the exporter to find more alternative financing sources and be able to expand and be empowered to seek and explore new markets, being in emerging markets or overseas markets that are somehow that look scary in a first instance, but by having this added value through the right structuring of transaction and finding, of course, the funder that is willing to fund. This is all about high value to the corporates. And this cannot be done unless there's technology. It's a data-driven platform. It's all about AI. And as you said, the machine learning, the feedback loop, and over time, the machine is learning on so many fronts that this kind of service is really upscaled.
I think it's an amazing solution. I guess in this whole ecosystem thing, where does the bank sit? So are banks being disintermediated by all of this? We've talked about the disintermediation of banks for a long time, haven't we, Andre? And all sorts of different contexts and over so many years that it seems almost like an old chestnut to be talking about. Banks are developing their own ecosystems, but they're not creating marketplaces as such, although there are one or two marketplaces in the commercial banking sector, as you mentioned. So are banks being disintermediated? And if so, how can they stop that process? Or where are they still relevant, do you think?
Yeah, I think the banks on the trade finance side are really getting spoiled with fintech propositions. Spoiled because all of those fintechs, and I manage 45 of them, I coordinate 45 of them in the fintech committee, as you know, of ITFA. They all are willing to partner with banks, to collaborate with banks. Why? Because on the trade finance side, providing technology versus running a balance sheet is a completely different business. Either you're specialized in technology and you're really positioning as a tech provider on the front office, on the back office, and you want to work with those who are running balance sheets. And that's the role of banks, to run balance sheets in the most effective way. And it's a very specific situation we witness in trade finance, which is completely different on the payment side, because processing payments is not as complex as managing a balance sheet for trade finance. So fintechs are tempted to move from technology to becoming a payment provider, because the step is very little from a regulatory perspective, from a risk perspective. I always tell my friends that in payments you debit before you credit, so there is no risk. You have the money, you move it from one place to the other, whereas in trade we credit before we debit, so we need to manage the risk between the two milestones. So fintechs are not interested on the trade finance side, from what I see with those I work with and with the broader group we have in ITFA. They are not interested in becoming banks. They start without partnership with banks often, and then as they evolve, they need more funding, and they're trying to work with banks or with non-bank FIs that have appetite for trade, but discovering trade, but do not want to become the front-end platform to manage corporate relationships. So I don't see any risk for banks here because of the complexity of the business. I see also a strong evolution over the last 3-4 years, where banks are really partnering with a lot of different marketplaces, ecosystems, platforms, sometimes investing in those as well on a direct basis, and trying really to leverage all of those channels to basically to source more transactions.
I totally agree. And do you mind, Rebecca, to add a few words? I think the days of fintech as a disruptor is over. We're really witnessing that the banks are really finding a complementarity with the fintechs, whereas the fintechs are probably playing the role of the customer fronting interface, and they can see now the real value of fintechs being agile, being flexible, more user-friendly, and probably articulating better the interest of those clients, being the corporates. I think it's now confirmed that it's all about a collaborative approach.
I couldn't agree more. And I think one of the really interesting things here is that what fintechs are doing is actually making the system more flexible so that banks can start to look at the SME side. So, I mean, if I answered my own question at the beginning, which is what are we actually trying to achieve with all of this technology? It has to be widening access to small companies in emerging markets and in developed markets in order that they can access trade finance. And I guess I welcome questions from anybody else in the session, but I guess the final imponderable that I want to think about, and I'd love us to spend some time considering, is around, okay, so small businesses are beginning to be able to be integrated into these types of systems through the types of the Fineon platform. But one of the challenges that's coming to the banking sector and to the technology sector, and it's coming as a result of COP26, is increased regulation that will be like KYC and AML, but for sustainability. Now, how do we avoid that? You both know I have a very strong view on this and the solution as well. But how do we go about making sure that we are incorporating sustainability into all of these things so that we can also help SMEs to become sustainable? And that's a huge ask, because it's not just about finance, it's also about changing behaviors.
Yeah, for sustainability is an opportunity for those who are really active in sustainable economy to basically advertise their business by sharing more ESG related data in their transactions, because this is the data that the funders, the banks, and the ones in the background in the distribution space, credit insurer, institutional investors will be looking for and defining their investment policies on. So data sharing is critical here, and the more scoring, market benchmarks, standardization the market develops around how to structure that data, how to define ESG scores, the better, of course. So data sharing will be the next kind of fashion to advertise to attract funding to your transactions, basically.
So I think that's really interesting. And Michel, I'll come to you in a minute, but I mean, it's data sharing. So we've had open banking in the UK, we've had PDS2, we've had open data, we're looking at open data, but now it's open sustainability data as well. So it's allowing your bank or your insurance company or your credit insurer or your accountant to have access to other things that will give an idea about, for example, your carbon footprint in your bills of lading or those types of things. Michel, how do you see the situation?
At the end of the day, through the data aggregation. So today we're living in a world where in the old days, we used to have data. Today there's data and there's alternative data. So from big data being the raw data that is available, directly available, then the alternative data that comes into the equation. And the real challenge today is what I call good data. So there's lots of data, there's an amplification of gathering data, but at the end of the day, it's a harmonization of the data. So putting the relevant data into a structured data kind of structure, and then connecting the relevant dots. And this goes for ESG, goes for transparency. And I think that the next challenge is really an equation of trust versus value. I was attending Money 2020 last September in Amsterdam, and participating in one of those think tanks. And there was one of the gurus in data saying, today from a B2C approach, there's almost no more trust in Facebook, but there are lots of people still using Facebook because it provides a certain value. So is it a new trustless environment? And this goes as well into your identity, your KYC. We're seeing now what Swift is doing in terms of KYC and many others. Okay, so I think we're going towards a new reshape of the data foundations that will create the sustainability ecosystem.
I would love to comment on that, because I think that the issue about value is very important, and it's been one of the things that's really come out of today's sessions, and you've just articulated it beautifully. And I think one of the things that we're looking at now is, instead of supply chain finance, as soon as we start talking about sustainability as well, we should actually be looking at value chain finance. So we're looking at where value is added, you know, classic Michael Porter, all the way along the value chain to get to the very end, where we're looking at sales and distribution and sustainability all the way through. So it's actually adding an ESG value all the way through. So what I'm going to do, unless there are any questions from the floor at this stage, I'm going to ask both of you to look into your crystal balls. So when we are here in a year's time at our Future of Strategy event, what are we going to be talking about in terms of the things that have been achieved in data and technology enabling trade, and how are we going to get there? Andre, I'll start with you.
I think the market will work on the basis of instant access to transparent transaction data. So if you claim something is a transaction has this attribute, you need to be able to prove it, to show where this attribute is actually linked, or how the transaction is actually including that attribute. So claiming something will have to be proven on the basis of a fully traceable transaction data record. So transparency, instant access to transaction data will become the norm, because it will feed automated processes such as the AI processes, and those AI processes will help take decisions like fraud decisions, credit decisions, but will also feed predictive models to know which frauds might come up, because the whole AI technology works on contextual monitoring. So the AI engines have an ability to predict, because they see things coming in their algorithm. It's already in place for fraud detection, but there is more to come on the credit side as well. So I think this transparency, this instant access to data feeding automated processes is becoming the norm, not just on supply chain finance, but on other trade finance processes as well.
Cool. And that also leads, of course, to document origination and being able to prove, you know, I mean, particularly in the sustainability space, as we all know, it's very important that this is something that can't be gamed by the individual company, that it has to be the original source. So in a year's time, we're going to be talking about AI systems that are based on, and technology that's based on original documentation that's enabled through technology. Amazing. Michel, what about you? Where are we going to be in a year's time?
Okay, I don't have any crystal ball, but I think that as fintech is leading the supersizing of financial services, the big winners are the consumers, and probably in trade finance, it's about the corporates. As they become more exposed to more fit-for-purpose options within their appropriate contextual journey. And this is becoming possible from the big data to the good data, or in other words, transforming raw data into actionable, investable transactions. And in a second instance, as financial services are becoming a native component and through the embedded finance, and somehow from the other side, unbundling such financial products is opening the way for more value-oriented relationship model. So talking about value, it's all about this super conduits that create a new relationship model. It's all about finance of value. So definitely in the old days, as a platform, as a trade finance platform, we were labeled as a fintech. Then came out trade tech. Some of the VCs look at us as data tech. But I think what will really come up very soon is what I would call client tech. So it's all about creating value to the corporate, to the client. Client is king, the corporate is king, okay? And those are the drivers of the economy.
Brilliant. And maybe I'd like to add another SOC tech on that, just as we draw the conversation to a close, which is SOC tech, which is the ability to be able to change society and the environment and sustainability through effective trade finance as well. And hopefully Coriolis and Fineon are both in that space to some extent as well. Thank you very much indeed for a really stimulating conversation. We've managed to keep the conversation going for 45 minutes, and I think we could probably have gone on for a lot longer because there's so many areas to discuss. Thank you so much for your time. Really enjoyed this conversation, and I look forward to seeing you later in the week at various other events. Just to remind everyone who's here now, we're going to be talking tomorrow about how we implement this for businesses, talking a lot about SMEs tomorrow and how they access this type of support, and then on Friday bringing the whole thing together and talking about sustainability and bringing the whole event to a close. So I'm really looking forward to everyone engaging tomorrow as well. We start at 9:30, and thank you very much indeed. Cheers.
Thank you, Rebecca.
Thank you.
Thank you, Michel and Rebecca. Bye-bye.
Bye.
Cheers.